let's start. Obviously, exam technique is very important. So when looking at a question like this, obviously this is the MAC exam 2602. It's the MayJune 2017 paper. What I would do is I would look at the questions here, and I'd be looking for the easier questions to start off with, because you can build marks, and remember, you need 50% to pass. So you obviously want to try to do the easier sections first and then leave the more difficult for the end. So looking at this, multiple choice is always a good idea, because that takes it doesn't take a lot of time, and it should be quite easy to get right. And then you're also looking for this analysis of financial information. If you have ratios, that's also easy marks. Okay, so financial ratio is also important, because you just need to study, literally. You just need to remember the equations, so like current ratio, quick ratio, all those different equations. That's all. So I'd be looking for things like that. And then time value of money as well. So depending on you, what you find most, let's say, easy, or what you're most comfortable with, I would start with that. So maybe start with question 4 if you like time value of money. Or if you know your ratios well, then do 3. But try look for questions that are easier to do. And obviously you need to stick to the time allocation. So obviously we've got 12 minutes to do the multiple choice. In the exam, it shouldn't be taking you longer than that. If it is, then you're either working too slowly, okay, or the questions might be a bit more challenging or a bit more difficult, and you might not be as comfortable with that particular section. So that's why I'm saying rather do the sections that you're more comfortable with, because number one, you're probably going to get it right, and number two, you'll probably save some time as well. Because remember, exam pressure can be quite challenging, especially if you're trying to do the whole exam in 2 hours. Okay, so I don't know if you have problems with finishing past papers, or if you generally struggle with time management in your other exams. Okay, but that's just things that you should be looking out for, not only this exam but in all exams. Okay, so I'm just going to start with question 1 and just run through it from question 1, 2, 3, and 4. It's not going to make much of a difference now, because we're discussing it, we're revising, and we're answering the questions. But obviously in the exam you'd want to do the more easier sections first. Okay, so the first one is looking at multiple choice. You've only got 5 questions, so that's not a lot either. Each question is considered independent. Okay, that's important, because it's not a follow-on, so you don't have a scenario and then you have all these different questions. Okay, so maybe let's just shrink this a bit. Okay, and let's put up the answer. Okay. Alright, so there's the first one. Question 1. 10 marks. The first one is 1.1. And 1.1 says, which one of the following is the definition for the strategy of an organization? Okay, so when you see a question like this, obviously they want a definition for the word strategy. That's what they want. Yes. And they're asking you to choose the one that's correct. So number A, it defines where the organization wants to go in the future. Well, that's correct, but it might not be the most correct answer, but it's a possibility. Okay, if the organization is wants to go in the future, defining what they want to do in the future, that could be more a goal than a strategy. Okay, but remember, the strategy is going to help you get to that end goal. Right, number B, it is about choosing long-term activities to achieve the purpose set out in the mission statement and ultimately moving towards realizing the vision. Okay, see, that's a better statement. Right, because that statement covers more than just looking at what we're going to do in the future. Okay, so B is looking good. C, it defines the core purpose of the organization by broadly stating the reasons why the organization exists. Okay, remember, a strategy is quite specific. So if you have a strategy, you're going to be doing certain things. It's going to be a little bit more detailed than that. Okay, so I don't like C, because C is too broad. Okay, it defines the core purpose of the organization. The core purpose wouldn't be the strategy. The core purpose would be more the mission statement or the vision. Okay, so I wouldn't go with C. And then D, it clearly formulates measures of progress and targets. No. Okay, it doesn't formulate the progress or targets. Okay, that's ways to measure performance, okay, and outcomes. Right, so strategy is looking at definitely B, choosing activities to achieve a goal or a mission or a vision. Okay, so option B. Let's just write B. Okay, question 1.2. And this is probably coming straight out of the textbook. So obviously, if you wanted to actually check this, you could probably go to the study guide and you could go look at the chapter where we covered strategy. I mean, there's 28 chapters, so it's a lot. That's going to maybe take a bit too much time. Obviously, some things I would check and just confirm in the textbook, just to make sure we've got confirmation. Okay, but something like this, you should be able to answer without having to refer to the textbook.
Yes.
Okay, 1.2. Which of the following statements are true? Okay, so true meaning there could be ones that are false. You have options to choose multiple answers. Number 1. The control of shares and assets in another company can be acquired. Can you? Yes, you can. Okay, you can buy shares in other companies, and you can also buy assets in other companies. Okay, so if I buy an asset from another company, that's possibility, so definitely something that you could do. Regarding the change in ownership, yeah, so obviously if you're changing ownership of a company, someone else is buying the company, so that would definitely change hands. Number 2, a company takeover is also a way to expand the existing company. Well, that would be correct. Okay, so if the existing company is buying other companies, well then you're expanding. The existing shareholders will be entirely or largely replaced by new shareholders. So the existing shareholders, so shareholders that currently own shares in the company currently will be replaced by new shareholders. That would be true. Okay, because the old shareholders would be bought out because it's a takeover. Right, so it's like what happened with South African Breweries, SAB. Okay, the Brazilian company, AB InBev, they bought control of SAB, so they took over. Okay, they took over that company. So obviously the existing shareholders were paid out, and now the new shareholders are obviously the new company. Okay, so that one's definitely true. The ownership of a company can be restructured by way of, for example, buyouts. Okay, a buyout, we need to just double check. A buyout would be buying out equity that has been issued. So they said the ownership of a company can be restructured by way, for example, of a buyout. Possibly, because if the company is buying out their shares, they're buying back the shares that they've issued. Okay, so possibly. Okay, we'll just keep that one aside, and let's look at the last one, 4. The company that takes over the other company will obtain full control over the policy formation and management of the company being taken over. The company that takes over the other company will obtain full control. That's true. Okay, if you're taking over another company, you would have full control of that company in terms of policy, management, and all of that. Okay, so just number 3, we just need to double check. Let's just look for the word buyout. Buyout in the... let's see, okay, change in ownership here. Okay, buyout is in chapter... What chapter is this? Oh, I'm looking at the last chapter, page 72. It says here, take over, change in ownership. It says, take over is a term referred to the transfer of control of a company from one group of shareholders to another. Okay, they said buyouts, takeovers, and restructuring are ways by which the ownership of a company can be restructured. So that is also true. Okay, yeah. So a buyout was right in terms of you're buying back the shares that you had issued previously. Okay, that's like a big company having millions of shares in the market, and obviously if the company wants to buy back some of its shares, they can do so. They can do that in the market, and then they would obviously change the ownership. Okay, it's a form of restructuring. So yeah, so definitely 1, 2, 3, and 4 are all correct. So option A.
A.
Right, number 3. VTC having a bit of cash flow problems. They signed an agreement with a financial company to pay a percentage of the approved sales up front. Okay, so upfront sales are being paid to the company. in an effort to have cash available. Okay, so that's a form of managing cash flow. For this privilege, VTC will pay an agreed monthly fee to the company. What form of finance will this be? Revolving credit? No. Factoring? Yes. Banker's acceptance back overdraft? No. B. Okay, you're selling part of your sales, your credit sales, if they're paying it upfront. Okay, factoring is when you sell your debtor's book. Right, what type of risk is described in the following definition? The risks that arise from activities of the organization and relate to the people, the processes, the products, and the structures. Okay, so that's look at the organization. Okay, business risk, possibly. Market, no. Economic, no. Financial, no. Yes, business is one, is right. Okay, it's looking internally, what's happening inside the business. Market risk is outside. Okay, that will be what's happening in the market. This is looking at people, processes, products, and structures. That's internal, that's business risk. Which of the following alternatives is false? Okay, so false, we're looking for the one that's wrong. Regarding risk identification and risk register. Okay, so we actually spoke about risk not so long ago. We looked at risk management, and we were focusing on all those different ways of managing risk in terms of the process. So here they want us to choose the one that's wrong. So 3 are correct. Risk or event identification is the process to identify internal and external events which could affect the achievement of the organization's objectives. Risk and event identification. If I'm identifying something, it would be identifying the internal and external. That would be correct. Brainstorming, pestle analysis, diagnostics, benchmarking are a few of the methods that can be used in identifying risks. Okay, there were quite a lot here. We just need to double check those. Let's go find the risk stuff again. This was chapter toward the end.
28. Yeah,
yeah, let's just check all the different measures when we looked at the risk identification. Okay, why is risk? Definition of risk. Okay, there they had those different standards. Okay, the URMSA, okay, that was the risk management definition. Okay, this was looking at different risks.
Risk identification and risk register starts on page 189
chapter 25.
This.
Yeah, chapter 25.
Yes, 25.
Okay, I see it as well. Okay, good. So, yeah, methods to identify risks. Control assessments, is that there? No, it's not. SWOT, pestle is there. We can tick pestle.
Yes.
Brainstorming
is there. Yes.
There. Benchmarking is there. Diagnostics is there. Yeah, so it's correct. There. Right, then you've got King 3 report and code are used in South Africa to guide the process of identification of risks in organizations. That's looking at more corporate governance. Okay, it does deal with risk,
yes,
but it's not only that. So I don't quite like it because they could have described that in more detail. Let's just check number D.
Yes, sir.
Risk register done by the risk management department is a summary of identified risks which are listed, described, and assessed and measured. Okay, that sounds good. Let's just double check risk register. Risk register is on page. Yeah, it's just after the documentation of risks. Yeah, a risk register summary of identified risks which are listed, described, and assessed and measured. Perfect. Yeah, so C obviously isn't right. Okay, and there you go. See, 10 marks for doing that, and that took us what? 12 minutes. Yeah. Okay, but that's even with checking and discussing and all of that. So obviously, having studied this, you should be able to do it a bit quicker.
Yes, sir.
Okay, so C was the wrong answer. Well, C was false, which is the right answer. Okay, but we're looking for the one that's wrong. Okay, what do we have here? Let's see. Question 2. 25 marks, 30 minutes. Brick and Tile Limited, okay, is a one-stop brick specialist. The company is a leader in the supply of all types of bricks and pavers. Okay, so it's always a good idea to see what you're dealing with. So I know I'm dealing with a company. I've been given financial position here. Then I've been given additional information. I can see I've got equity here, and I've got financing. So it's probably a capital budgeting question. Okay, then you've got required. Okay, this is what gives you the most, let's say, guidance in terms of what they're
sir.
dealing with. Right, so A is calculate the current cost of equity using the capital asset pricing model. Okay, that's cap M. Okay, cap M is easy because it's a formula. Right, so let's write that down. Question 2 now. Now we're starting with the long questions. Okay, so cap M is looking at required return. Required return is risk-free plus beta, open brackets, the market return, minus the risk-free. Okay, that's a formula that you need to learn. Okay, it's just something in finance that is used a lot. Just make sure you know it when you go into your exam. That's the formula. You write down your formula, then you go find the right figures. Okay, they said we needed to calculate what? A was to calculate the cost of equity using the capital asset pricing model. Okay, so here we're looking at the cost of equity. So we're not going to worry about debt here. Focusing on equity. Right, so I want to know what equity costs are. So let's go back to the question. Beginning just tells you what business they are. Okay, that's bricks and pavers. Okay, then there's an extract of the statement of financial position. So now I know how many shares they've issued. Ordinary issued shares, 11 million. Non-distributable reserves, retained income. See, this is all equity stuff. And then you've got debentures and long-term loans. That's liabilities. Okay, so you've got the equity at the top. You've got the liabilities here. So that's your equity.
Yes, sir.
Okay, then you've got debentures, long-term loans. Okay, additional information. Brick and tile has a beta of 1.1. There we go. That's something that I need for my cap M.
Oh, yes.
Market rate is 18, risk-free is 9. So there you go, you got everything. Okay, so plus 1.1, open brackets, 18 minus 9, close brackets equals. See how easy that is? Cap M. 18.9%. That's the rate. And that's it. 3 marks for that. Show the formulas used and detailed calculations. Round your answer to decimal places. Well, this answer isn't being rounded off. It's a nice whole number. Okay, so no need for rounding there. Got that?
Yes, sir.
Okay, B. Calculate the market value of the debentures by using the mathematical formula. Show the formulas used and detailed calculations. Round your answer to the nearest rand. Okay, they want to know market value of the debentures. Okay, so that means that the debentures are going to be priced according to the market. Okay, so you've got the financial position, which is the debentures here. So that's your debenture finance, but now obviously there's a market value to your debentures, and that'll be in the dish information. Okay, so we've looked at brick and tile, we've looked at that. There are currently 2 million shares in issue, current market price. Okay, that I don't need. I'm looking at debentures. There we go. This is what I need. Okay, so B is going to focus on that.
Yes,
Currently, there are 10,000 debentures in issue at face value of 900 each. The debentures are redeemable after 5 years on 28 Feb at face value. The coupon interest paid is that before tax. The market interest rate for similar debentures is 13%. Okay, so apply time value of money to bond valuations. That's basically what you're doing. Okay, and you've done this in DSC as well, so you should be okay with this. Your PV, your FV, well, PV is what I'm solving for. So my FV, my N, my I, my PMT. Solve for PV. That's what I'm going to do. Okay, so what's my future value? Well, read the question, look for face value. Face value 900 Rand each. Okay, so 900 Rand each.
Is my future value.
900 Rand each is your future value. Yeah. Okay, but there's 10,000 debentures, so we would have to multiply that by
10.
It's actually 900 times 10,000.
10,000. That's by 10.
Okay, so 900 times 10,000 is 90 million. No?
9 million. Yes, sir.
Alright, then they tell us that the debentures are redeemable after 5 years, so N is 5. I is the coupon, no, not the coupon rate, it's the debenture finance of 13%. Okay, market interest rate. The coupon interest being paid before tax. Okay, before tax. Well, they wanted the value of the debentures. Tax wouldn't be applicable here. It would only be applicable when looking at the weighted average cost of capital, your WACC. Okay, so I'm not going to use that for this one. Okay, let's just put that here. Payment would be negative, well, positive because you're paying it out. So it's 1080123. Okay, 1.08 million. Right, and then solve for your present value. Okay, so then now you grab your financial calculator. You got your compound interest.
It's 8. If I hope I'm reading this correctly, it's 8,683,449.1864. So.
Okay, let's check. Okay, what did you say?
83.
449.186. That's good.
449.1864. Yes.
Yeah, that's good. Okay, that's good. You got it. Okay, so that's it. Calculate the market value of debentures using mathematical formula. Okay, see, the problem is, do they want you to use a formula? If they do, then that's being very picky, because it shouldn't matter how you get the answer, because the financial calculator can actually get you the answer, and the answer is actually very correct.
Yes. Right. Oh, I didn't see the mathematical formula.
Yeah, they said mathematical. So now, does that mean you have to do it mathematically? Okay, because this is mathematically, it's just not a formula, but remember, it's still the right answer. Yeah. So if you want to use a formula, then you're going to have to use that discounting stuff. So then you're discounting, so formula-wise, I'm just going to show it to you. Formula-wise, you're going to have to use the present value, which is the future value times 1 plus the rate, close brackets, to the power minus n. Okay, and then you're going to have to use that present value, the PV of an annuity formula. Okay, and then you have to do two calculations. So then in this one, you would have FV of 9 million. You'd have an N here of minus 5. Well, N is 5, just it'll be a minus in the formula. And then your R is obviously 13%.
Yes.
0.13 if you're using a formula. Okay, and then with your present value of the annuity formula, you'd have to do the same thing there. So your PMT is 1080000. Your N is 5, and your R is 0.13. Okay, see, it's the same thing, and then you plug that into your calculator. So now, if I work out the PV separately, PV here equals, PV there equals.
Okay. Well, for the first one, I got a 4884.839.424.
Correct.
And
that's right.
Then I'm working.
And then you do the other one as well.
PMT 5 is N, and then 13 is my. And then wait, did this present value of an annuity, that one, it's fine that you do it with the calculator.
Well, see, the thing is, remember, they said use the formula, so then you'd have to actually use the formula. That's the only problem with this.
Yes.
But you see, okay, like I say, I don't know what they're expecting in terms of the examiner, because I didn't set the paper, but I'm just looking at their question, and their question is focusing on, obviously, mathematical equations. So now the thing is, if they want the specific mathematical equation, then they might only give marks for that versus using the calculator. But see, the thing is, you're still going to get to the same answer. That's why I don't know how particular are they in terms of doing these calculations. Do they give you a formula sheet here?
When I looked, because I didn't print everything, but I didn't see a formula sheet, but I did see the tables.
Yeah, the tables are here. Tables are here. Tables are here. Tables are here. That's it. Okay, yeah, no formulas. Okay, so if there's no formulas, then you're gonna have to know the formulas if that's the case. So if they wanted you to do it mathematically. So then I would have to get the present value formula. I'm just trying to find it here in the book. What page is it on?
Present value for, I'm not sure if I think I was reading it earlier.
I see the future value one. Okay, the present value of the single payments. The present value of an ordinary annuity. Okay, so then you would literally be using this. Let me copy this. See, if they wanted you to do it manually, then you'd have to plug all of that into this equation. Into that thing. You see that thing there?
Yes, sir.
Okay, and then the same thing with the other one. Where's the other one? Here, present value of a single payment, and then you have to plug it into that. See, so if they wanted formulas, you would do this for that, and you would do this for that, and then you would get those answers. And then if you add up those two answers, do you get the same answer? You should. See, this plus that gives you, see, the same thing. See that?
Yes, sir.
Yeah, so now the thing is, I don't know how picky they're going to be in terms of, are they going to mark you wrong if you just show this, but then you get the right answer? Okay?
Yes.
I don't know. Okay, UNISA has to confirm that. I don't know if they would tell you what they're going to be allocating marks for. Because the thing is, you got the market value of the debentures, that's the thing. But if they're saying using the mathematical equation, now, are they going to penalize you if you don't use the formula, but then you get the right answer? I don't know. Okay.
Yes, yes.
Right, but there's both ways. So whatever you prefer. This is the quick, easy way. Grab the financial calculator, plug it in, get the answer. This is if you want to be long and take the actual mathematical equations. If you want to play with the numbers, the maths.
Yes.
Okay, and then you would just plug in those values. So like payment here, this PMT value would go into the I here. This phi would go into the N there. This 0.13 will go into the I there. You see that?
Yes, sir.
Okay, but you'll get the exact same things. Okay, C. Calculate the cost of debentures. Show the formulas used and detailed calculations. Okay, they want the cost. Okay, they already gave you the cost. Where was that point? I think I saw it, didn't I? No. Okay, so, I saw the tax. Yeah, the tax is going to be used to calculate the cost. So what do they want you to calculate here? They want you to calculate the after-tax cost. Oh, it is there. Okay. Yeah, the market interest rate for similar debentures is 13%.
Yes, sir.
Okay, these are 9 million rand debentures, and they're redeemable in the future. So if you're looking at the cost of debentures, remember, debt is going to be after tax. Always. So after tax costs equals before tax costs times 1 minus the tax. Okay, you're just taking tax off. Okay, so before tax costs were 13%. Tax was how much in this question? Corporate tax 8%. 0.28.
Oh, yes.
Okay, so 13 times 0.72 gives you 9.36. That's the cost of debentures. Okay, remember, debt instruments is always after tax, because interest is tax deductible. Okay, D. Calculate the WACC of brick and tile. Okay, that's easy. Okay, WACC is brackets weighting of debt times debt. And then add weighting of equity times cost of equity. Right, so there's your formula. You write down the formula, you put in your weightings. Okay, so this requires those amounts at the top here. There we go. The following is an extract of brick and tile. Okay, I need the weightings. Okay, so total finance equals whatever it is, and then obviously that's broken up into two, debts and equity. Does it make sense?
Yes, sir.
Okay, so ordinary shares issued, equity 11, non-distributable reserve 910, retained income 53 equals, sum up all of that. Total equity 17.21 million. Debt, debentures of 9 and long-term loan of 7.55. Total 16. Total finance, debt and equity added together. That's okay. Do you see what I did there?
Yes, sir, I did.
Okay, so now I can get the weighting. Okay, but I need to check the costs. Alright, so I've got the cost of equity. Where we given different costs here? There are shares at the market price. Okay, debentures there, market interest or similar long-term loans. Okay, there's the important one. Okay, see, there's the long-term loans. Okay, so the long-term loans has a separate cost. Okay, so I have to show that one separate. So debt is going to be broken up into two. That's going to be weightings of debentures and weighting of long-term loan. Okay, do you see that?
Yes, sir.
Okay.
So why do we separate them if debentures also kind of debt, sir?
Yeah, you separate because they've got different costs.
Oh, okay.
Okay,
Yes.
so the debentures cost how much? There's the debenture costs. Okay, the debenture cost was how much? 9.36 after tax. Do you see that?
Yes, yes, sir.
Okay, and the long-term loan cost is 11% after tax. See that?
Yes, sir.
Okay, so they're different. Okay, so WACC equals, open brackets. How much debentures am I using? I'm using 9. 9 million. Divide by the total, 33 million. Times the after-tax cost of debentures, 9.36. Plus, how much long-term loans do I have? 7.55. Divided by the total, 33.76. Times after-tax cost of the long-term loans, 11 after tax. Plus, equity. How much equity do I have? Well, equity is 17.21. Divided by total 33.76 times the cost of equity, which we worked out earlier. Where's cost of equity? Where's it? Here's it. Cost of equity 18.9. That's it. Copy paste, get the answer. .59% WACC. Okay, and that's it.
Also, So with with the debt, so we got 16.55. So did we split it between the debentures and the debt?
Yes, long-term debt and debentures. This makes up the total.
Okay, so
Okay, because remember, it's coming from two different sources.
yes, so
Okay. Got that?
yes,
Okay. E. Show the components of total equity finance amounts as well as the components for the total debt financed amounts separately. Then calculate the capital structure of Brick and Tile Ltd based on book values. Okay, so here they said book values. Round your answer to the nearest percentage. Okay, so they want to split. Okay, so I actually kind of did that here. I'm just going to copy this diagram and put it down here. Okay, and then we'll make a nice pretty table for it. Okay, so sources of finance. Okay, obviously you've got different sources. So I need to list them all. Okay, so let's start with debts. And then equity. What is the 11 million for? Okay, ordinary shares. I'm just gonna write reserve instead of the whole thing, just it's shorter. And then retained income. Okay, so debentures was this, that, ordinary shares was that, reserves was that, retained income was that. Okay, so they want to know the percentage. Okay, obviously the totals is adding those two amounts together. Total finance for this company is this plus that. Okay, so as a percentage, that's what they wanted, right? Let's just go back and check. Calculate the capital structure. Round off to the nearest full percentage, yes. Okay, so percentage. Okay. The total is that. So this percentage would be this divided by that times 100. Okay, so there's it. Okay, and then I would have this. Okay. What is this one? This one divided by that. Okay, so that divided by that. 100%. Okay, so you see all of these. So this plus that will give you the total. Do you see that?
yes, sir.
Okay, and then obviously the debentures makes up 26% of the financing. Did they say round your answers to the nearest full percentage? Okay, read the question. They say nearest full percentage. So all of these figures need to be rounded off to those numbers. Okay. Right, so it's literally just a weighting. You're just trying to work out the percentage of finance that's coming from all the different sources. Got that?
Yes, sir.
Okay. It's more maths than anything else there. Happy?
Yes, sir.
Okay, that's 2 done. question 3. Okay, 3 is a big question. 33 marks, 40 minutes. That's a big one. Okay, so there's a lot that we need to do here, and there's also 2 parts. See, part A here, there's the first part. There must be a B here. Is there? Yeah, there's the B. Okay, so you've got a lot to do here. B looks like theory, just from the looks of things, and then A looks like calculations. Okay, this is a 33 mark question. It's out of 40 minutes. It's a long one. Okay. Important, start with the required. Okay, so A, redraft the extract of the comparative statement of profit and loss and other comprehensive income for Isitombi Productions by using the indexed statements technique. Okay, indexed statements technique. So that's something that you would have studied. That we need to go back and double check. Indexed statement. Where is that? What chapter is that? Do you have it?
No. I can't remember what chapter it was actually, but I do remember. I think it was towards the end-ish of the first book.
End of the first book. Okay, so it's the first book, not the second book.
No, it was the first book.
Okay, let's look for it. I've got WAC here, Study Unit 13, Sources of Finance. TVM here, Legal Forms of Businesses, Financial Management Functions, Overall Objectives of the Business. Stakeholders, Factors, Strategic. No, it's not. It must be the second book.
That's the second book.
Second book, Contents page has what? Let's see. Analysis of Financial Information. There's it. Okay, ratio analysis, there's it. Okay, we want the index method, which is probably going to be in the first one, analysis. Okay, so let's go check it. Okay, I got the common sized one.
Yeah, I've gotten to.
You found it.
It's around about page 13, sir. But
page
then
13.
yes, sir. But on page 13, I'm looking at the feedback of the activity of the index statement.
Let's go back and check. Is this ratio analysis?
Just before ratio analysis section. Yes.
Oh yes, there we go. Index statements. There we go. Perfect. Alright, you got it. Okay, so index statements uses the base year as the focus. Okay, that's easy enough. Okay, so what years do I have here? I've got 2016, 2015, 2014, 2013, 2012. Okay, they only want you to prepare what section? Redraft the extract of the statement of profit and loss. Okay, where's the profit and loss? This is the extract of profit. Okay, so only this. That's all they want you to index. Okay, then that's very easy. Okay, if they just want you to index that, then that's simple. First, you need to draw it up. Okay, so extract of the statement of comprehensive income. Okay, how many years? 2016, 15, 14, 13, 12. Okay, I've got EBIT, and I've got interest expense. Okay, so we need to write in those figures. So 1831, negative 1601. Actually, I'm going to keep it as a number. I'll just put it in red. Okay, 1765, 1801, 860, 930, 1654, 1346, 1540, 1303. Okay, So common size statements, meaning you have to use that as your base. Okay, so then I need to write down indexed statements. Okay, or index statement of comprehensive income. Okay, so I'm gonna literally copy paste that, except I'm gonna make this 100 and this 100. Okay, so 13's formula will be this amount. Okay, that was 13th EBIT. Okay, so bracket it. Okay, minus. Oh, it's a percentage of. So actually, it wouldn't be minus. It'll be divide. It'll be divide by that times 100. There we go. Okay, so that's the same thing. Okay, we're indexing that here, so that we need to fix that. Fix it. There we go, and fix this. Okay, so I'm just going to show one calculation, then you would literally repeat it. So 2013, how did I get that? I did this. 1540 divided by 1303 times 100. You see that? Do you see that?
Yes, I've seen the calculation. I'm looking at
860 divided by 930 times 100. Gave you that. You okay there?
Then you repeat that for each year.
Yes, for every year. Okay, so work out 2014 one. Work that one out.
Okay, I'll work at the 2013 one.
Do both.
Okay, 1, 3, 4, 6.
You should get that.
3, 3.
Did they want you to round this off? Let's check. What did they say here?
2014, I got 103.
Round your answer to no decimal place. Okay, so no decimal place.
Okay, so it's just 1034. 2014. One, 1 divided by 937 times by 100. It's 194.
Did you get them?
Yes, sir. Yes, I did.
Okay, it's
After
easy,
the second one, yes, sir.
Alright, so that's what you have to do for those. Okay, B. Given the additional strategic non-financial information provided, provide context to the analysis done in A. Per line by explaining a possible reason for the changes. Okay, from 2014 to 16. Alright, so they want you to explain this. From A. This is B. Okay, so this is commentary. Okay, explain why we had those changes. Right, so go to the addition information. There's it. Okay, main revenue stream is from production of live music. Equipment was sold and started giving problems, and they had to spend a lot of money on repairs. Okay, did the EBIT go up or down? It went up, not down. So that's a good thing. They had to buy equipment, finance this new equipment with long-term loans. Okay, from 2014 onwards, they experienced cash flow problems due to the high interest payments on the long-term loans into the acquisition, and started investigating new financing options. Okay, the company requires a permanent base of net working capital of that. they have two choices: finance all their working capital short term, finance all their permanent working capital temporary. Okay, so that's what we got in the addition information. So based on the addition information, explain what the possible reasons are for those changes. Right, so obviously in 2014, what happened? They had cash flow problems. What did they decide to do? They decide to finance this elsewhere. See, they said from 2014 onwards, they experienced cash flow problems due to the high interest rates on the long-term loan entered into the agreement. Okay, into the acquisition of the new equipment, started investigating new financing options. So new financing options taken on, or financing options, new financing options used. Okay, long-term interest costs reduced. Okay, they must have refinanced it elsewhere that reduced their cost of long-term finance. Because if you look at the information here, they have two choices: finance all their working capital with short-term debt. Notice short-term debt is at an interest rate of 16%. 2, finance their permanent working capital with long-term debt. Long-term debt, you can see, is 20%. So long-term finance is more expensive than short-term finance. You see that?
Yes, sir.
So more short-term used, which is cheaper than long-term. Reduction in interest costs or interest expenses. Okay. Right, EBIT. EBIT is looking at the sales part. So have the sales increased? It must have. They just spoke about new equipment, buy new equipment to keep up with technology. And they in terms of the main revenue stream is from the production of live music shows. Okay, so new technology purchased. This would increase production, leading to more sales. Okay, there you go. 4 marks for doing that. Explaining what happened from 2014 to 2016. Got that?
Yes, sir.
Okay. Then you've got part C, which is your ratio analysis. See, this is where you need your equations. Okay, so number 1 they want is interest cover. And then they want the debt ratio. Okay, so here, this is where I go to my textbook and I get those formulas. So that would have been here. Okay, ratio analysis. Where's my formula? Interest cover. Okay, there's the formula. That's the interest cover formula. Debt ratio. Debt ratio or gearing ratio is given as this. Okay, so this is what you study, this is what you get from your study guide. Copy paste that and then do the working. See that?
Yes, sir.
Easy, right?
Yes, sir.
Okay, so go to the question and look for those amounts. Alright, so the interest cover, what year did they want though? Calculate the ratios for the years 2015 and 16. So we need 2.
Yes.
And state whether the ratio has increased or decreased. Also present an explanation. Okay. So 2015, 2016. Right, interest cover in 2015 is going to be what? Let's check. Okay, so interest EBIT. So EBIT is for 2015 1654 divided by interest expense 1765 close brackets. Gives you that answer. 2016 1831 over 1601 gives you that answer. Okay, then they want the debt ratio, total debt over total asset. That I need this. Okay, so did they give me totals here? They didn't give me totals, so I need to add up. Okay, so debt ratio in 2015, I want my total debt over my total assets. Okay, so total debt in 2015, non-current liabilities plus current. 4603 plus 1293 close brackets over total assets, non-current plus current, 7295 plus 1333. Okay, gives me a debt ratio of that. Okay, in 2016 I want to do the same thing. Debt would be 4542 plus 1309, and then your assets, non-current and current, added together. Non-current is 7591 plus 1158. Gives you that answer. Okay, then they want you to comment. Okay, so state whether it increased or decreased. Okay, so let's talk about this one first, then let's talk about that one. Okay, so interest cover has increased from 2015 to 2016. Got that. Reason. Okay. Revenue slash sales slash EBIT has increased, and interest expenses have reduced. Has reduced. Okay. Right, and you can maybe talk about the technology thing here, but we already spoke about that earlier, so I don't think you need to mention it again. Okay, so you can obviously talk about technology improving or using more short-term finance than long-term. Short-term finance was cheaper than long-term finance, and that's why you had the interest cover go up. Make sense?
Yes, sir.
Okay, then here, debt ratio has decreased from 2015 to 2016. Okay, let's explain why. Well, looking at this, what has happened to your non-current assets? Non-current assets have gone up. What has happened to your current assets? They've gone down. Non-current liabilities, non-current has gone down, current has gone up because that was the long-term, that was the short-term finance. See, less long-term finance, more short-term finance. So in terms of debt ratio, it decreased, but only slightly. So only a slight change in the debt ratio. The company has grown its assets. More than its liabilities. And therefore, the debt ratio has decreased. Okay. Right, I don't think they'll be too picky about the way you explain it, as long as you're using the material in the actual question. So I would definitely be talking about the assets going up. You could have maybe said, well, the non-current assets went up by a bigger amount than the current assets decreasing. Okay, and you could also say, well, the non-current liabilities decreased by a bigger amount than the current liabilities increasing, if that makes sense. So obviously we're looking at the net effect. Okay, the net effect was what? An increase in the current assets in terms of total assets. Maybe what you could do is you could do this. Okay, if you wanted to add more to this answer. Okay, 2015, my assets were that. My liabilities were that. Okay, and then in 2016, okay, 2016 assets were that, and liabilities were that. Okay, so you can see that liabilities have gone up or down? Down. And you can see assets have gone up.
Yes, sir.
So does that make sense?
Yes, it makes sense.
Okay, so if you want to, you can show that as well, more workings. Okay, but at least then you've actually shown that as well. Happy?
Yes, sir.
Okay, and that was E, right?
That was C.
That was
yes,
C.
sir.
Okay, so now we've completed that 19 marks. Okay, now we've got 14 marks for part B. Okay, so new part. Did I label this part? Where is it? We're on question 3.
We are on question 3, so part B.
Yeah, so part A we've done. Let's label that correctly. And then label this B. Okay, so part B. Management has heard of aggressive and conservative financing policies. Briefly explain what an aggressive financing policy entails. Then calculate the cost of the aggressive financing policy and show detailed calculations. Okay, fine. So that's theory. I just want to get the theory from the textbook. Aggressive financing. Is that book 1 or 2? Which one?
Financing. I think it was in book 1, so if I remember correctly.
Check.
When we were still talking about financing, the differences, the equity, and
yeah, I see the source of finance, capital structure. Yeah, probably. Let's just check for it. This is aggressive. No, I don't see it there.
It's in book 2. I just felt like book 2 had way more calculations than it did theory, actually. So
It looks like it. Okay, yeah, it is here. Okay, so okay, I've got the conservative one here. I'm going to take this through to our working. So there's conservative. This is from page what? 85. No. Okay, that's 85 on the PDF. 76. Okay, aggressive is at the bottom of that. So aggressive starts here. That's conservative, this is aggressive. See that?
yes, sir.
Did they want advantages and disadvantages as well, not?
No, I didn't see that. I think
Okay, then
there's
you
one,
probably
two,
didn't take
two.
all of it. I just took too much then. Briefly explain what it is. Yeah, okay, so just explain what it is, then that's all you have to do. Then they say, calculate the cost of the aggressive financing policy. Okay, so aggressive is looking at using long-term and short-term. Remember that.
Yes, sir.
Okay, so where's my question? Go back to the question. Oh, what year? Did they say what year?
It was.
They don't
No,
say.
so they
How are
didn't
you
say.
supposed to work it out? Do they want all 4 years? That'll be quite something. But for 4 marks, I don't think so. But we'll have to do it then. With all 4 years. Sure, okay. Alright, so let's just look at this. Okay, the financing we need. Okay, so there's the important bits. We need the cost, obviously. Okay, and did they only want aggressive, hey?
Yes, sir.
Okay, so just write down one heading. I'm gonna need those costs here. Okay, so financing, long term, short term. Okay, so all years, 2016, 15, 14, 13, 12. Okay, so long-term finance in 2016 was how much? 1309. Did I write this down earlier? No. Okay, pity. I was gonna take it. It's fine, let's write it in. Current live. Oh, wrong one. That's long term. That's
So-
short term. What's wrong?
Can I ask, with aggressive, was it not more short term than it is long term?
Aggressive is when you need finance, you'll finance it, and when you don't need finance, then you'll so permanent is using long-term financing.
Yes, sir.
Okay, so remember, if it's aggressive means, well, you're just going to need the bare minimum. When you need more, you'll go find
Yes.
more.
Okay, sir.
Okay. Conservative is you get everything up front. Does it make sense?
Yes, sir.
Okay, so totals. Sum up all of them. Okay, so there's the totals that I'm going to need. Okay, so over the 4 years, I'm going to need 14,126. Okay, it's obviously in thousands, so it'll be 14 million. Okay, obviously there's triple zeros. Okay, you see the notation?
Yes, sir.
Okay, so just add that in. Alright, so that's the total finance. Okay, so you could work this out year by year by year. It's only for 4 marks, so I don't think they'd want year by year. I think they'd probably want the total and that's it. Because to work it out for each year seems a bit too much. Okay, so if I'm looking at aggressive financing, I'm obviously going to use, what was the rates? Here's it. Number 2, to finance the permanent working capital with long term at a cost of 20% and the temporary working capital with short term at 14%. There we go. Okay, so the cost of this is 20% and the cost of this is 14%. Okay, so this times 20%, this times 14%. Total cost. Sum up that. Okay, so you see that's the cost, but that's the total cost. Now you could do the same thing for every single year if you wanted to. So
Yes.
if you wanted to do it year by year, so on a year by year basis, okay, then I would literally do this for every single year, and the short term times 14%. Okay, then I would do that for all those years. Okay, for 2016 to 2012. See, but I don't think they're gonna want all of that. Okay, but I could be wrong. You never know. So if you wanted every single year, then you'd have to do that. Then that would have been the cost for the first year. This times 20%. This times 14%. See, those are the individual costs every year. You see that?
Yes, sir.
Okay, and if you sum it up, then you would get that. Okay, and then the total cost here should be the same. Yep, they are. Okay, so you can see that there's it on a year by year basis, and the totals if you want the totals. But yeah, I think that's just too much. That's a bit way too much for what, 4 marks. But anyway, okay, that was part BA, right?
Yes, sir.
Part BA1, 4 marks.
Yeah.
Okay, so part B A1. Two, briefly explain what conservative, calculate the cost of conservative finance. Okay, so I've actually done 1 and 2 together. 1 and 2. Okay, so it's actually, it might be worthwhile doing all of it then, because I read the one question and then I just thought you had to do both, but it's split actually. Do you see that?
Yes, sir.
1 once aggressive, 2 once conservative, and then that's 8 marks in total. So I've done both here. Well, I've done aggressive here. Conservative. Okay, I actually do need to add conservative. Okay, so conservative is going to be using what? Permanent everything. Do you agree? That's
Yes,
what they
sir.
said in the question. Where is it? Here's it. They have 2 choices. Option 1, to finance all their working capital with short-term finance at a rate of O. Okay, that's short-term. Okay, that's not what we're looking at. We're looking at everything long-term. Okay, because it's conservative financing policy. Do you see that?
Yes, sir.
Okay, so if it's conservative, that means all the yearly funding requirements long-term finance. Okay, so the funding I'm going to need again. Hey, yeah, these were the this was the funding. Okay, actually, let's take all of that. Okay, but all I'm going to be looking at is the totals, because this is conservative. Okay, so adding up all of that. Okay, so if I'm looking at the cost, okay, the cost of conservative finance is how much? It's the long term. What is the long term financing cost?
Is this after you've multiplied it by 10%?
No, 20%. Yeah, 20% is the long term financing cost.
So I think 2825.2 is it?
Yeah, well, 20%. So rate at 20%.
Oh, so it's just 10. Oh.
Okay, so this times 20%. This times 20%. All of it times 20%. Okay, and there's the costs. Okay, so that's conservative, and then this was aggressive. Okay, now that's complete. Got that?
Yes, sir.
Okay. Alright, what else do we have? 3. Based on your knowledge of the problems, as well as the costs and effects of the two different financing, advise management which policy they should follow. Okay, that's easy. Obviously, they're going to use which one? Come, you tell me.
They're gonna use the conservative, sir.
Conservative, look at the costs, more or less.
Oh, it's like it's more.
It's more. So which is cheaper?
Yes, sir. Oh, the aggressive.
Yes. Okay. Okay, we know aggressive is cheaper. Why?
Because of the total, sir?
No.
Well, after comparing the... Sir?
Why? The cost of borrowing.
Oh.
Finance is higher than short term. Okay, so if we use a conservative approach, more long term finance is used, which is more expensive. Does it make sense?
Yes, sir, it does.
Okay.
I was just looking at the theory now as well. It's short term.
Yeah. All right. So 4. Briefly explain the matching maturities concept as applied in the moderate financing policy. Okay, so that's literally go to your textbook and find matching, and then just write down what they said there. There's the matching maturities concept. Let's see, did they give you anything else? Matching maturity concepts. Okay, so what did they want here? Briefly say the matching maturities concept as applied to moderate. Okay, moderate financing though. Okay, so this is short term. Okay, well here's the basic rule. Let's copy this. Okay, so let's describe it first of all. Okay, this comes from the textbook. What page is this on? I got this from page 69. Okay, and then let's see the moderates. Is there a specific debate about the moderate financing policy matching security? Okay, this is probably better. This is on page what? 77. Rather use this. Okay, here's something else on page 77. This is probably better. Okay, I like this one more. Okay, because it actually talks about the moderate financing policy. It's 2 marks, it's just theory. Got that?
Yes, sir.
Okay. 5. With reference to working capital management, supply 2 advantages of short-term financing. Okay, that's easy. Just go find the advantages from the textbook, and you can write down any 2. There'll obviously be more. You just need 2. Okay, so short-term financing advantages. Have you found it? Do you have a page number there? Okay, I've got a
Oh,
page
sir.
number here. Okay, there we go. I found it. 69. Okay, on page 69 you would take this. Any two. They've given you 4 here. Do you see that?
Yes, sir.
Okay, so advantages of short-term financing, they give you 4. You can decide which 2 you want to write down for 2 marks. Got that?
Yes, sir.
Okay, great. Right, and then we've got one more question to do. Question 4. Okay, I'm going to just quickly pause and take a bit of a break here. We've gone on for quite some time now. But see, have a look at our time. We're actually doing quite well.
Yes.
We've looked at about an hour and a half now, and we still have one question left, which is 38 minutes. Okay, so
Yes, sir.
it is possible to complete the exam on time. You just need to work carefully, and obviously you need to study your theory quite well, because they do tend to test quite a bit of it by the looks of it.
Yes, sir.
Okay, yeah, so this is the first time I'm actually seeing a MAC2602 exam in detail, and I'm covering it with you now. So you can sort of see what type of questions they're testing you and what the focus is. So my tip for you would be definitely focus on past papers in terms of theory, because theory is going to be taken straight out of the textbook. Okay, and if they've
Yes, sir.
tested aggressive and conservative here, they could possibly test it again in the future.
Yes, sir.
Okay, it might be a different question, but they could still test it. So use the past papers as a guide to see what theory is more important. Because remember, you've got 28 chapters. That's a lot. So to have to study everything 28 chapters wide, it's a lot. So I would rather use the past papers as a guide so that you know what you should be focusing on.
Yes, sir.
Okay.